Let me tell you about a woman named Linda. Linda is 58 years old. She has worked for the same company for 31 years. She showed up every single day. She did her job well. She raised 2 kids, paid her mortgage, kept her family afloat through redundancies and medical bills and all the unpredictable things that life throws at people who are just trying to do the right thing. By every reasonable measure, Linda is someone who deserved to be okay financially by now. Last year, Linda sat down with a financial advisor for the first time in her life. She had been putting off the meeting for years because she was not sure she wanted to know the truth. The advisor pulled up her numbers. Her retirement account had $54,000 in it. After 31 years of work, after 3 decades of showing up, $54,000. The advisor told her that at her current trajectory, she would need to work until she was 71 to retire comfortably. Linda is 58. That means 13 more years of alarm clocks and commutes and difficult days for a retirement that should already be in sight. Linda is not unusual. Linda is the reality for millions of Americans who did everything they were supposed to do and still arrived at their late 50s with a number that does not match the life they worked to create. Meanwhile, a completely different group of Americans, people who did not earn dramatically higher salaries, people who did not inherit family wealth, people who never got lucky picking the next big stock will retire with portfolios worth 10 times, 20 times, sometimes 50 times what Linda has. Not because they were smarter, not because they were luckier, because at some point early in their working lives, someone sat them down and explained something that the school system, despite having 12 years to do it, somehow never got around to. This video is that conversation. The one Linda never had. Everything a complete beginner needs to know about investing, explained in plain language with no jargon, no condescension, and no agenda, other than making sure you finish watching this with a clearer picture of your financial future than you had when you clicked play. The difference between Linda's outcome and the person who retires comfortably often comes down to one decision made in the 20s or 30s or even 40s. The decision to actually begin. And by the end of this video, you are going to understand exactly what to begin, why to begin it, and how to begin it starting this week. Drop in the comments right now, did anyone ever teach you about investing growing up? A parent, teacher, mentor, anyone? Because the answer most people give to that question explains more about the wealth gap in this country than almost anything else. Now, before going any further, let me address the thing that stops most people before they even start: the fear. Investing sounds like something that requires a finance degree, or a large amount of money, or a level of technical knowledge that ordinary people simply do not have. The terminology alone is enough to make most people close the browser tab and go back to whatever they were doing. Bear markets, bull markets, ETFs, index funds, expense ratios, ticker symbols, limit orders. It sounds like a foreign language, and the financial industry has spent decades making sure it stays that way, because confusion is profitable. Confused people pay advisors. Confused people buy products they do not understand. Confused people leave money in savings accounts generating almost nothing, while the financial industry uses that same money to generate significant returns for itself. Here is what that industry does not advertise. Investing done correctly for a complete beginner is genuinely simple. Not easy, simple. The simple version does not require you to understand corporate earnings reports or predict what the economy will do next year or pick winning stocks. It requires you to understand a small number of basic concepts and then act on them consistently over time. That is it. And here is something that should make anyone who has been putting this off feel a lot less alone. A survey found that 44% of people said a lack of knowledge was the main factor stopping them from investing, and 41% said they were scared of losing money. If you feel the same way, you are in the majority. This is not a personal failure. This is the predictable outcome of a system that never taught you what it should have. Before going further, putting together videos like this takes a serious amount of research, writing, and production. None of it is quick. If this video gives you something genuinely valuable, the single best thing you can do right now is subscribe. It costs nothing. It takes 2 seconds. But for this channel, it means everything, because the more subscribers there are, the more YouTube pushes these videos to people who genuinely need them. If you believe this kind of content matters, please subscribe right now. It makes a real difference. Now let us talk about why investing matters. Because if you do not understand this in your gut, not just your head, everything else falls flat. There are 2 fundamental reasons to invest, and both of them are more urgent than most people realize. The first is inflation. Inflation is the rate at which the cost of everything around you increases over time. The United States Federal Reserve targets approximately 2% annual inflation as their goal for a healthy economy. You feel that in your daily life, even if you have never thought about it in those terms. A Chipotle burrito that cost $8.50 6 years ago costs closer to $12 today. That same burrito, same ingredients, same size, nearly 50% more expensive. If you had $50,000 in 2019, you could have bought roughly 5,882 of those burritos. Today, that same $50,000 buys you approximately 4,166 purchase. You lost 1,700 burritos worth of purchasing power without spending a single dollar. That is inflation, making your money worth less every year it sits still. At 2% annual inflation, your money loses approximately half its purchasing power over a 35-year working career. Not through bad decisions, not through bad luck, just through time passing and prices rising the way they always have. This is why keeping significant sums of money in low-interest savings accounts over long periods is one of the most quietly destructive financial decisions a person can make. At best, you are treading water. At worst, you are slowly losing ground every year while feeling financially responsible, because at least you are saving. The second reason to invest is compound growth. And this is the concept that Albert Einstein reportedly called the 8th wonder of the world. When you truly understand it, not just intellectually, but in your gut, it changes your relationship with time permanently. Compound growth means growth on top of growth. Your money earning returns. Those returns earning returns. The interest earning interest on the interest. It sounds simple because it is, but the effect it produces over long periods is almost impossible to fully appreciate until you see it in real numbers. Here is a simple example first. You invest $1,000 and earn a 10% return. At the end of year 1, you have $1,100. In year 2, you earn 10% on $1,100, not on the original $1,000, so you end with $1,210. In year 3, 10% on $1,210 gives you $1,331. Every year, the base gets larger. Every year, the growth gets bigger. Leave that original $1,000 completely untouched for 20 years, and it becomes $6,727. You added nothing. You did nothing. The compounding did the work. Now, here is where it gets genuinely life-changing. 2 people. Call them David and Marcus. David starts investing $200 per month at age 25. He does it consistently for exactly 10 years and then stops completely. He never adds another dollar after age 35. Total amount. David invested $24,000. Marcus starts investing $200 per month at age 35 and keeps going every single month until he is 65. He is diligent and consistent for 30 straight years. Total amount. Marcus invested $72,000. At age 65, assuming both earn the historical average annual return of 10%, David has approximately $676,000. Marcus has approximately $452,000. David invested $24,000. Marcus invested $72,000. David invested less than a third of what Marcus invested and ended up with $224,000 more. Not because David was smarter, not because he worked harder, not because he earned more, because David started 10 years earlier and gave compound growth more time to work. Those 10 years are worth $224,000. They cannot be bought back at any price. They cannot be recovered by investing more aggressively later. And for most people watching this, for Linda and for millions of people like her, those years are already gone. Not because those people were irresponsible, because nobody showed them this example when it still would have made a real difference. That is why this video exists. Tell me in the comments, how old are you right now and have you started investing? Because that answer determines exactly how urgently the rest of this video applies to you. Now let us talk about what stocks and bonds actually are, because these are the two main building blocks of almost every investment portfolio, and most people have only a vague idea of what either of them really means. A stock is a small piece of ownership in a company. When you buy a share of Apple, you are buying a tiny fraction of Apple's total ownership. When Apple generates profits and its business grows, the value of your ownership stake grows with it. When Apple pays dividends, portions of profit distributed to shareholders, you receive a proportional payment. You are a part owner, an extremely small part owner, but an owner. Stocks in aggregate have performed well historically. Global stocks have returned approximately 8% annually before inflation, or approximately 5% after inflation over the last 125 years. The trajectory over long periods is consistently upward. But in any given year, any given month, stocks can swing dramatically in either direction. This is where most people confuse two things that are genuinely different: volatility and risk. Volatility is the degree to which an investment's value moves up and down in the short term. Risk is something different. Risk is the probability of not reaching your long-term financial goals. And here is the counterintuitive truth that most beginner investment content never explains clearly. Over long periods of time, 20 years, 30 years, stocks may actually be less risky than many people assume, despite being more volatile. Because while stocks move dramatically in the short term, the historical evidence shows they have never failed to produce positive returns over any 20-year period in modern market history. The volatility is temporary. The long-term trajectory is consistently upward. Bonds are the other major building block. When you buy a bond, you are essentially lending money to a government or a company. In exchange, they agree to pay you regular interest and return your original investment at a fixed date in the future. Bonds do not change in value from day to day as dramatically as stocks do. They are less volatile, but they also have lower expected returns, historically between 4% and 6% annually compared to stocks at approximately 10%. The way to think about stocks and bonds in a portfolio is like a balanced meal. If you only eat one type of food, only pasta, only salad, only protein, your body eventually suffers. You need a mix that works together. An investment portfolio works similarly. A stock-heavy portfolio should be expected to be more volatile with higher expected long-term returns. A bond-heavy portfolio should be less volatile with lower expected returns. The right balance depends on your time horizon and your genuine ability to stay calm when markets drop. Someone who is 25 years old with 40 years until retirement can handle significant volatility because they have time to recover from any downturn. Someone who is retiring in 5 years needs more stability because a major market drop right before they need the money could be genuinely devastating. The general principle that most financial educators apply is that the younger you are, the more heavily you can weight towards stocks. As you approach retirement, gradually shifting toward a higher proportion of bonds provides more stability for the money you will actually need to use. Now let us talk about something that most beginner investors completely overlook: the health savings account, or HSA. If you have access to a high deductible health plan through your employer, you may also have access to an HSA. Most people think of it purely as a health care account. But Financial educators increasingly describe it as the most powerful investment vehicle available to ordinary Americans because of what is called the triple tax advantage. First, contributions to an HSA are tax deductible. The money you put in reduces your taxable income in the year you contribute. Second, growth inside the HSA is completely tax-free. Every dividend, every capital gain, every dollar of compound growth accumulates without any annual tax. Third, withdrawals for qualified medical expenses are tax-free. No tax going in, no tax growing, no tax coming out. No other investment account available to ordinary people offers all three of those simultaneously. And here is the additional detail that most people miss. If you are healthy enough to pay current medical expenses out of pocket and simply leave the HSA untouched, the money compounds for decades. In retirement, you can withdraw from the HSA for any purpose, not just medical expenses, with the same tax treatment as a traditional IRA. And given that healthcare costs are one of the largest expenses in retirement, having a dedicated tax-free fund available for those costs is extraordinarily valuable. For 2026 contribution limits and eligibility rules, please verify through official IRS sources as these change periodically. And as always, the specific decisions around which accounts to use depend on your individual situation, a conversation worth having with a qualified financial professional. Now, let us talk about why the stock market specifically makes sense as the primary investment vehicle for most beginners. Because there are other ways to invest: real estate, gold, cryptocurrency, collectibles. And understanding why stocks are the recommended starting point matters. Stocks have three characteristics that make them particularly suitable. First, they are liquid. If you own a rental property worth $400,000 and you need that money next week, you are in serious trouble. You have to list the property, find a buyer, negotiate, handle inspections and legal paperwork, and wait for closing. That process takes months at minimum. If you own $400,000 in an S&P 500 index fund and you need money next week, you press a button, the shares sell in seconds. The cash hits your account within days. Second, stocks are accessible. You can open a brokerage account in 15 minutes, deposit whatever amount you have, and immediately own a piece of the largest, most profitable companies on earth from your phone, on your couch. Most major brokerages charge zero commissions. Many allow fractional shares, meaning you do not need hundreds of dollars to participate. You can start with $5 or $10 or $25, whatever you genuinely have available. Third, stocks have reliably produced strong returns over long periods. The S&P 500 has produced average annual returns of approximately 10% since its inception. Over the past 30 years, approximately 10.3% annually. Over the past 50 years, approximately 12%. The pattern across different measurement periods is consistent. Patient, long-term investors have been rewarded. No other liquid accessible asset class has matched this track record. Now let us compare a savings account versus an investment account to make this concrete and personal. Scenario 1. You put $500 per month into a savings account, earning 4% annually. After 30 years, you will have approximately $346,000. You contributed $180,000. Over that period, you earned $166,000 in growth. Decent, but nothing life-changing. Scenario 2. You put the same $500 per month into a diversified stock portfolio, earning the historical average of 10% annually. After 30 years, you will have approximately $1.1 million. You contributed the same $180,000, but you earned over $900,000 in growth. Same monthly contribution, same time frame, 3 times the result. That entire gap comes from the difference between 4% and 10% compounding over 30 years. That is why investing, that is why time is the most valuable asset any investor possesses. And that is why every year of delay is more expensive than the year before it. Now, here is why most people still do not invest, even when they understand this intellectually. They are afraid of picking the wrong thing. And that fear is completely legitimate. Nokia was the dominant phone brand in the world in 2010. They controlled nearly 37% of the global phone market. By 2020, their market share had dropped to less than 1%, and their stock had fallen approximately 70%. Anyone who had invested their savings in Nokia believing it was safe and dominant lost nearly everything. Meanwhile, the person who simply bought the whole market barely noticed Nokia's collapse because it was one of hundreds of companies they owned spread across dozens of industries. Individual stock picking requires significant research, carries concentrated risk, and produces outcomes that vary wildly. For every person who bought NVIDIA in 2019 and watched it increase tenfold, another person bought a different technology company at its peak and still has not recovered their investment years later. The data is clear. The majority of actively managed funds run by professional investors with entire research teams and unlimited resources underperform simple index funds over periods of 10 years or more. If professionals with all of those resources cannot consistently beat the market, what realistic chance does someone researching stocks on their phone in the evenings actually have? This is where the most important concept in beginner investing comes in. The index fund. Think about the music charts. Every week, there is a list of the most popular songs. Songs that perform well move up. Songs that stop performing well drop off and get replaced by better ones. The chart constantly updates itself to reflect what is actually happening. An index fund works on almost exactly the same principle, except instead of songs, it tracks companies. The S&P 500 is a list of the 500 largest publicly traded companies in America. Apple, Microsoft, Amazon, Google, Tesla, Johnson & Johnson, JP Morgan Chase, and 493 others. Companies that grow large enough get added. Companies that shrink or fail get removed and replaced by stronger ones. The index constantly updates to reflect the current reality of the American economy. When you invest in an S&P 500 index fund, you are not picking any individual company. You are buying a tiny piece of all 500 of them simultaneously in one single purchase. Which means if any one company has a catastrophic year, your overall investment barely notices. If a whole sector struggles, the other companies across dozens of different industries continue generating returns. Your success does not depend on picking winners. It depends on the overall American economy continuing to grow over time. And based on 150 years of evidence, it has consistently done exactly that. Now, here is something worth thinking about regarding diversification beyond just U.S. companies. Consider Japan. From 1,970 through January 1,990 Japanese stocks, more than doubled the annualized return of the rest of the world's stock markets. Japan had become a globally dominant economy, and investing anywhere else seemed almost unnecessary. The narratives about Japanese innovation and efficiency made the country seem economically unstoppable. If you had invested in Japanese stocks in January 1990 after that extraordinary run of performance, you would still today not have fully recovered your investment in real terms when adjusted for inflation. Meanwhile, an equivalent investment in the rest of the world's stock markets would have grown many times over across the same period. The lesson is not that Japan is a unique cautionary tale. The lesson is that no single country is guaranteed to keep outperforming indefinitely. This is why many financial educators recommend some level of global diversification, owning not just American companies, but companies from developed and emerging markets around the world. A globally diversified portfolio means your returns are not entirely dependent on any single country's economy continuing to outperform. A simple starting portfolio that many independent educators suggest might look something like 60% in a total U.S. market fund, 20% in an international fund covering developed and emerging markets outside the U.S., and 20% in a bond fund for stability. But complexity is not correlated with returns. The simplest portfolios often outperform complicated ones because they are easier to maintain and easier to stick with during difficult periods. One broad market index fund tracking the S&P 500 or a total market index is a perfectly reasonable starting point for a complete beginner. Start simple, add complexity later only if it serves a genuine purpose. Because index funds do not employ armies of analysts or pay fund managers to make decisions, their fees are extraordinarily low. And fees matter far more than most beginners ever realize. Here is what fees actually cost in real money. You invest $500 per month for 30 years at an average annual return of 10%. With a 1% annual expense ratio, typical for many actively managed funds, you end up with approximately $900,000. With a 0.03% expense ratio, typical for low-cost index funds, you end up with approximately $1.1 million. That 0.97% annual difference costs you approximately $200,000 over 30 years. Not to poor performance, not to bad decisions, to fees, quietly, every year, compounding against you in exactly the same way compound growth compounds for you. This is why the expense ratio is one of the most important numbers to look at when choosing any investment product. And it is why low-cost index funds with their microscopic fees are the starting point almost every credible independent financial educator recommends for beginners. Warren Buffett, widely considered the greatest investor alive, has repeatedly and publicly stated that for most ordinary people, the wisest investment strategy is to put money consistently into a low-cost S&P 500 index fund and leave it there. Not to pick individual stocks, not to time the market, simply to buy the index consistently and patiently over a long period of time. When the greatest investor in history says that is the best strategy for most ordinary people, that is information worth sitting with seriously. Has this changed how you are thinking about investing? Tell me in the comments. And keep watching, because what comes next is the part that most beginning investors either do not know about or significantly underutilize. Let us talk about the accounts that can dramatically accelerate everything. Think of your investment account like a container. You can put the same investments inside different containers, and the container you choose determines whether you pay taxes on your growth every year or whether that growth stays entirely yours. The 401k is the most common workplace retirement account in America. If your employer matches your contributions, that match is an immediate, guaranteed return on your money before the market does anything at all. A typical match might be 50% of your contributions up to 6% of your salary, an immediate 50% return on every dollar you contribute up to that limit. This is free money. And declining to contribute enough to capture the full employer match because you feel like you cannot afford the contribution right now is one of the most quietly expensive decisions most people make without fully understanding what it cost them over 30 years of compound growth. The Roth IRA is the other account that most independent financial educators point beginners toward early. With a Roth IRA, you contribute money that has already been taxed, but the growth inside is completely tax-free. Every dividend, every gain, every dollar of compound growth accumulated over decades, when you withdraw in retirement, you pay zero tax on any of it. For a young person who expects to be in a higher tax bracket in retirement than they are now, the Roth IRA is one of the most powerful financial tools available. And then there is the HSA, the health savings account, which most people ignore entirely. If you have access to a high deductible health plan, the HSA offers what financial educators call a triple tax advantage. Contributions reduce your taxable income today. Growth inside the account is completely tax-free, and withdrawals for qualified medical expenses are also tax-free. No tax going in, no tax growing, no tax coming out for healthcare costs. No other investment account available to ordinary Americans offers all three simultaneously. If you can pay current medical expenses out of pocket and leave the HSA growing untouched, it becomes one of the most powerful long-term wealth building tools available. Contribution limits and eligibility rules for all of these Accounts change periodically. Please verify current limits through official IRS sources and consider speaking with a qualified financial professional about what makes sense for your specific situation. This is educational information only, not financial advice. Now let us talk about timing, because this is where most beginning investors make their most expensive mistake. There is always a reason to wait. The market looks too high, a recession might be coming, the political situation feels uncertain, interest rates are behaving unusually, and people who wait for the perfect moment to begin almost universally discover that the perfect moment never arrives. By the time they feel comfortable enough to start, they have already missed years of compounding that cannot be recovered. Here is a fact that should permanently change how you think about this. The S&P 500 spends approximately 8% of all trading days at all-time highs, roughly 20 days per year when the market has never been higher than it is at that moment. Research consistently shows that buying at all-time highs produces essentially the same long-term returns as buying at any other time. Markets that reach all-time highs tend to keep reaching new all-time highs. The trajectory of long-term stock prices is upward. Waiting for a dip usually means missing the gains that accumulate while you wait. And here is the statistic that makes this genuinely alarming. A study found that if you miss just the 10 best market days over a 30-year period, you would lose approximately 54% of your total gains. Missing 20 of the best days would cost you 73% of your gains. Missing 30 would cost you 83%. The best market days are almost impossible to predict. They frequently occur during or immediately after periods of maximum fear and bad news. The investor who stays invested through the scary moments captures those days. The investor who sells during the scary moments misses them entirely. And the difference between those two outcomes measured over 30 years is hundreds of thousands of dollars. But here is the psychological reality that makes all of this genuinely difficult. If you invest today and the market drops 20% next month, you are going to feel terrible. You are going to want to sell just to make the feeling stop. Think about Linda again. She watched colleagues lose money in 2008. She read frightening headlines every time markets fell. She told herself she would start investing when things felt more stable. Things never felt stable enough. And now she is sitting across from a financial advisor being told she needs to work until she is 71. The fear of losing money is real and completely human. But here is what the historical record actually shows. The stock market has dropped significantly 19 times in the last 150 years. Every single time it has recovered and gone on to reach new highs. In 2008, the S&P 500 dropped approximately 57%. By 2013, just 5 years later, it had fully recovered and exceeded its pre-crash levels. The COVID crash of 2020 took just 4 months to recover, the fastest recovery in history. In 2022, the market dropped approximately 19%. A $100,000 portfolio became an $81,000 portfolio. Many investors panicked and sold at the bottom, locking in their losses permanently. By 2024, those losses had fully recovered for anyone who had stayed the course. The investors who build real wealth are not the ones who avoided every downturn. They are the ones who understood that downturns are normal, that recoveries are historically reliable, and that selling during a crash is almost always the single worst response to a temporary situation. This is why dollar cost averaging is the approach most recommended for beginners. Investing a fixed amount at regular intervals regardless of what the market is doing. Instead of investing $12,000 all at once, you invest $1,000 per month for 12 months. When prices are high, your fixed amount buys fewer shares. When prices are low, it buys more. Over time, you acquire shares at an average price that smooths out the volatility. But more importantly, dollar cost averaging removes the decision from each investment. You are not asking yourself whether today is a good day to invest. The answer is always yes, because today is the day your automatic transfer happens. Think about it this way. A young investor decided to invest the equivalent of 1 coffee per day, $5 every single day automatically into an S&P 500 index fund. Not because $5 is a life-changing amount, because it built a consistent habit and removed all the thinking from the process. Set it, forget it. Let the compounding run. Small, consistent, automated investing is more powerful than occasional large investments made with great deliberation, because consistency is what compound growth feeds on. And automation is what protects consistency from the emotions that would otherwise disrupt it. Fidelity once found that their best performing investment accounts belonged to people who had either forgotten they had an account or who had passed away. Not the most active traders, not the most engaged investors, the ones who set up a consistent system and then got completely out of their own way. Now let us talk about what actually getting started looks like. Because information without action is just anxiety. Before investing a single dollar, there are 3 things worth having in place. High interest debt, anything above approximately 7% to 10% interest, should be addressed first. Think of it like filling a hot water bottle with a hole in it. The water is your money. The hot water bottle is your investment account. The hole is your debt. No matter how much you pour in, the hole keeps draining it. Credit cards charging 20% to 40% interest are draining your financial future faster than almost any investment can fill it. Paying off a credit card at 24% is a guaranteed 24% return on your money. The stock market's historical average is approximately 10%. The guaranteed return of eliminating high-interest debt almost always beats the expected return of investing. Clear the hole before you try to fill the bottle. An emergency fund of 3 to 6 months of living expenses in an easily accessible savings account is the second prerequisite. Nearly 40% of adults cannot cover a $400 emergency without borrowing money. That is the financial vulnerability that forces people to sell their investments at exactly the wrong time. When markets are down and prices are lowest, your emergency fund is the buffer that prevents that. Build it before you invest. Once it exists, you can stay invested through market downturns because your immediate needs are already covered regardless of what the market is doing, and only invest money you will not need for at least 5 years. Ideally, 10 or more. Money needed in the next 1 to 3 years belongs in savings. Money you can genuinely leave alone for a decade or more, that is what belongs in the market. Once those 3 things are in place, here is the practical sequence. Step 1, decide how much you can invest consistently, every single month. Not what you wish you could invest, what you can genuinely commit to without financial stress. For some people, that is $25. For some, it is $500. The amount matters far less than the consistency. $200 per month for 30 years at 10% average return produces approximately $450,000. $500 per month produces approximately $1.1 million. $1,000 per month produces approximately $2.3 million. Find your number, commit to it. Increase it every time your income grows. Every raise you receive is an opportunity to direct a portion toward your future before lifestyle inflation captures it entirely. Step 2, open an investment account. In the United States, the most commonly recommended platforms for beginners are Fidelity, Vanguard, and Charles Schwab for traditional brokerage accounts. Each offers 0 commission trades, no account minimums, and access to the index funds most financial educators recommend. Research each carefully and consider speaking with a qualified financial professional about which account type Roth IRA, traditional 401k, HSA, regular brokerage makes the most sense for your individual situation. Step 3, choose what to invest in. For a complete beginner, the starting point most widely recommended by independent financial educators is a broad market index fund tracking the S&P 500 or a total market index. One fund, that is where most people starting from zero should begin. Not because it is exciting, because it is reliable, consistent, low cost, and historically proven over more than a century of market history. Step 4, automate everything. Set up an automatic transfer from your bank account to your investment account on a fixed date every month, ideally the day after your salary arrives, before there is any opportunity to spend it elsewhere. Then set up an automatic purchase of your chosen index fund. Then leave it alone. Review your portfolio twice a year at most. Increase contributions when income grows. Let time and compounding do what they do without your interference. Step 5. Learn to stay calm when it drops, because it will. Have a written investment plan that specifies in advance what you will do in various scenarios. When the market drops 20%, continue your automatic contributions. When the market drops 40%, continue your automatic contributions and consider investing additional funds if available. Writing this down in a moment of calm clarity means you have something to refer back to in the moment of fear, rather than making an emotional decision in the heat of a temporary crisis that permanently damages your long-term outcome. The goal is not to outsmart the market. The goal is to build a system that keeps you invested consistently no matter what the market is doing. The beauty of automation is that it lets you do exactly that quietly and without stress while the compounding runs in the background of your life. Now, here is something that needs to be said directly before this video ends. Think about Linda one more time. Linda is 58. She found out too late. She did not make obviously bad decisions. She did not gamble or spend recklessly or ignore her finances out of laziness or irresponsibility. She just never had this conversation at the right time. Nobody sat her down at 25 or 30 or 35 and showed her the David and Marcus example. Nobody explained what inflation was actually doing to the money she was dutifully saving every month. Nobody told her about index funds or compound growth or the employer match. She had been leaving unclaimed for years because nobody explained what it was worth. Nobody told her that the HSA sitting in her benefits package was one of the most powerful financial tools available to her. Nobody explained the difference between volatility and risk in a way that would have helped her stay invested through the 2008 crash instead of selling at the bottom. The system was not designed to give Linda that conversation. The school system found time for 12 years of other subjects, but not for this one. The financial industry profits from that gap. And so Linda found out the truth at 58, sitting across from a financial advisor, and the truth arrived 30 years too late to be as useful as it should have been. You are not Linda. You are watching this now, which means you still have time. Whatever age you are, the second best time to start is today. And the gap between starting today and starting next year is not nothing. Every year of delay at 10% annual growth costs you more than the year before it, because the base that the compounding applies to keeps getting larger. You do not need a six-figure salary. You do not need a finance degree. You do not need perfect timing or a large lump sum or a sophisticated strategy. You need a consistent amount you can commit to every month, the right low-cost index fund, enough patience to leave it alone, long enough for the compounding to do its work, and the wisdom to stay invested when the markets do what markets always do. One action this week. Open an account. Set up a contribution. Make the decision that Linda never got to make at the right time. The school system failed you on this. The financial industry profited from that failure. This video tried to close that gap. What happens next is entirely up to you.